Congratulations! You found the Santu Pirls Stock Market Commentary for market week ending Friday, March 6, 2015. Market breadth. With this past week's market fractional advance, our bull-bear point and figure ratio dropped from 1.46 to 1.22, remaining in bullish territory. The total count of securities in bullish or bearish patterns fell 2% to 2,962. The count of bearish stocks increased 9%, while the count of stocks in bullish patterns decreased 10%. The Santu Pirls PNF Market Breadth Summary Chart shows us a market now 5 consecutive weeks in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking on the Membership tab, and clicking Sign Up. For those who are interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 1 point for the 11th decline in 20 weeks. At a positive 197.53 points, it has made a new top and continues above the November 2014 top and below all 7 remaining tops above plus 100, as well as above all 7 bottoms below minus 100 in the last 3 years. Market Gauge Volume Analysis. In this week's volume analysis, all indexes ended in neither accumulation nor distribution mode. In the last 2 weeks, the Nasdaq 100 Trust had 0 accumulation days and 0 distribution days. Of the other indexes, both the Diamonds Trust and the S&P 500 Deposit Receipts ended in neither accumulation nor distribution mode. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, also, the Nasdaq 100 Trust ended in neither accumulation nor distribution mode. Momentum. In a Woody's uptrend, declining for the week at 36.40, the CCI 20 daily is now within the plus or minus 50 range for a valid Woody's zero-line reject signal, should one occur. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 33 weeks ago, while the daily CCI 20 began a Woody's uptrend 3 weeks ago. With the CCI 20 weekly at 158.61, falling from last week but remaining above our plus 100 exit point, we continue in the trade begun after the Friday 123 close, long zero-line reject entry signal. We will continue following the result of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. 4 of the top 5 industries are positive, and all of the bottom 5 are negative. Bullish, semis, networkers, brokers, and S&P retail continue in the top 5. Oil continues in the bottom 5. Bearish, REITs, and computer hardware continue in the bottom 5. Computer hardware and gold and silver have entered the bottom 5. Oil services has left the bottom 5. Focus this week from www.dariantimes.com. Rickards, a central banker's worst nightmare, presents the clearest understanding of the macroeconomic forces of inflation and deflation as managed by central banks that we have read in a long time. Here are a few key points. In inflation, consumers may accelerate purchases before the price goes up. In deflation, consumers may delay purchases in the expectation that prices are going down and things will be cheaper if they wait. To investors, inflation and deflation are bad in equal, if opposite, measure. But from a central banker's perspective, inflation and deflation are not equally bad. Inflation is something that central bankers consider to be a manageable problem and something that is occasionally desirable. Deflation is something that central bankers consider unmanageable and potentially devastating. Understanding why central banks fear deflation more than inflation is the key to understanding future central bank monetary policy. Central banks also believe that inflation can be good for an economy. This is because of something called the marginal propensity to consume, or MPC. The MPC is a measure of how much an individual will spend out of an added dollar of income. The idea is that if you give a poor person $1, they will spend all of it because they struggle to pay for food, housing, and health care. If you give a rich person $1, that rich person will spend very little of it because their needs are already taken care of, so they are more likely to save or invest that dollar. Based on this, poorer people have a higher MPC. Inflation can be understood as a wealth transfer from the rich to the poor. For the rich person, his savings are worth less, and his spending is about the same because he has a low MPC. By contrast, the poor person has no savings and may have debts that are reduced in real value during inflation. Poor people may also get wage increases in inflation, which they spend because of their higher MPC. Deflation is not so benign and hurts the government in many ways. Deflation also destroys government tax collections. But if the worker gets no raise and prices drop 10%, she still has a 10% increase in her standard of living because everything she buys costs less. But now she keeps the entire gain because the government has no way to tax the benefits of deflation. But what is good for government is often bad for investors. In deflation, investors can actually benefit from lower costs, lower taxes, and an increase in the real value of savings. As a rule, inflation is good for government and bad for savers, while deflation is bad for government and good for savers. The idea of MPC as a guide to economic growth is badly flawed. Even if poor people have a higher propensity to consume than rich people, there is more to economic growth than consumption. The real driver of long-term growth is not consumption, but investment. While inflation may help drive consumption, it destroys capital formation and hurts investment. Inflation is a case of a farmer eating his own seed corn in the winter and having nothing left to plant in the spring. Later, he will starve. In a better world, central bankers would aim for price stability that does not involve inflation or deflation. But given the flawed economic beliefs and government priorities described above, this is not the case. Central banks favor inflation over deflation because it increases tax collections, reduces the burden of government debt, and prompts consumption. If savers and investors are the losers, that's just too bad. This tug-of-war between inflation and deflation creates the most challenging investment climate in 80 years. Thank you for tuning in for this week's Sand to Pirls Stock Market Commentary, featuring the proprietary Bull Bear P&F Market Breadth Summary Chart, compiled by Donald Pirls, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you're looking forward to a wonderful week coming up, and wishing you true success.